Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down one of the most, one of the most interesting and, frankly, controversial companies on the market right now. The enterprise software giant, ServiceNow. Now, on the surface, it's the ERP for IT. It's this massive, entrenched business with elite retention rates that it essentially runs the back office of the Fortune 500. But the deep question for us as long-term investors, the real tension here is this. Is this company the blockbuster to AI's Netflix? I mean, is the market correctly pricing in the end of the entire seat-based software model, or is this a massive, massive overreaction that's providing a generational entry point? That's what we're here to find out.
That's a huge topic, and a really important one. Before we dive deep, just a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. You can use the link in the description, and you'll get a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time. Really helps us out.
And while you're there, please like, subscribe, and let us know your questions in the comments. We do read them.
Now, let's get into it. Pillar number 1, the SaaSpocalypse context and the business engine itself.
Okay, let's start with the pain. Because there is a lot of it in the software sector right now. A lot of red on the screen.
Oh, it's a bloodbath.
It really is. So we're looking at ServiceNow. The ticker is NNOW, N-O-W, and it's trading around, what, $102.63?
Roughly, yeah.
Now, for anyone who hasn't looked at the chart in a while, you have to remember that price reflects the 5-for-1 stock split they just executed.
Right, so don't think it fell off a cliff from 500. You have to adjust for that.
Exactly.
Yeah.
But even accounting for the split, the stock is down over 25% year to date. And we're only in February 2026. The narrative has it's shifted so violently.
It's a complete sentiment inversion. I mean, you have to remember, for the better part of a decade, these SaaS companies were seen as, like, the perfect business model.
The compounding machines.
The ultimate compounding machines. We had the rule of 40, companies where revenue growth plus profit margin was above 40%. They were given these massive premium multiples, and ServiceNow was, well, it was the king of that hill.
It was a poster child.
Absolutely. This company historically traded at 60 times earnings, sometimes 70 times, during the peak euphoria of the last few years. It was priced for absolute untouchable perfection.
And today, what are we looking at now?
Today, we are staring at a valuation compression that is, it's almost hard to believe if you've been following this stock for years. We're looking at a trailing PE of roughly 29.1x.
Wow.
Yeah. And if we look forward using the 2026 consensus EPS estimate, which is around $4.12, we're sitting at roughly 24.9 times forward earnings.
So the multiple has effectively been cut in half. More than half.
It's been vaporized. The market has taken a long, hard look at the future of software, at the future of work, and has decided that the premium that these businesses once commanded is, well, it's just no longer warranted.
And let's be clear, this isn't just a macro story. It's not just interest rates, right? This is something specific, this SaaSpocalypse narrative.
That's the key. It's this existential dread that artificial intelligence, specifically the new agentic AI we're seeing from places like Anthropic and OpenAI, is going to act as a massive deflationary force on software revenue.
Okay, break that down. What does that actually mean, deflationary force?
The logic goes like this. If an AI agent can do the work of a human employee, well, then companies will logically hire fewer humans.
That makes sense.
And if companies hire fewer humans, they buy fewer seats of enterprise software like ServiceNow. And since ServiceNow's entire business model for 2 decades has been charging per seat, well, the math gets ugly really, really fast.
That's the death of the seat thesis.
That is the death of the seat thesis in a nutshell.
Right.
It's the idea that the core unit of monetization for the last 20 years, the user license, the per-employee subscription, is about to just evaporate.
So if one super agent can do the work of 50 IT support staff, why would a company pay for 50 licenses anymore?
Why would you? You wouldn't. That's the entire bear case right there.
Right.
But before we decide if that fear is valid or if it's just, a market panic, we have to look under the hood. We really need to understand the black box.
What does ServiceNow actually do?
Exactly. Because I think a lot of people, even in finance, still think of it as just that help desk ticketing thing.
Right. The my printer is broken software.
It's a classic example. And you know what? If it were just that, I'd be shorting it too. I'd be right there with the bears. But it hasn't been just that for a very, very long time.
So what is it now?
At its core, ServiceNow is a platform for digitizing workflows. It's an engine. Yes, it started in ITSM, IT Service Management, which is indeed the printer fixing and the password resetting. But the founders realized something incredibly profound very early on.
What was that?
They realized that the process of requesting something, routing that request to the right person or system, getting it approved, and then fulfilling it, that fundamental sequence is the atomic unit of work in any large corporation.
So it's a pattern.
It's the universal pattern. It doesn't matter if there's request is fix my laptop or onboard this new employee or refund this customer or approve this marketing campaign. It is all the same fundamental workflow engine underneath.
So they just took that engine and started applying it to everything.
Everything. They went from IT to HR to customer service management, legal, even what they call creator workflows for developers. They call it the platform of platforms.
Okay, so that's the business, which brings us to the moat. In investing, we obsess over moats, sustainable competitive advantages. What is ServiceNow's?
It has one of the most powerful and, I think, misunderstood moats in the entire industry. If you're using the 7 Powers framework, it falls squarely under switching costs.
Okay, but I want to be specific here, because people throw that term around so loosely. We're not just talking about, oh, it's annoying to learn a new interface. This is something deeper.
Much, much deeper. This is structural lock-in. We came across this analogy during our research, and it's honestly the better way to think about it. The heart transplant.
I love that. It perfectly captures the anxiety a chief information officer must feel when they even think about this.
It's the only analogy that really fits. Think about how it's architected. ServiceNow isn't just an app you log into in your browser. When a large enterprise, let's say a global bank or a major hospital system, deploys ServiceNow, they are literally building their entire operational data model inside of it.
What does that mean, data model?
They have this core component called the CMDB, the Configuration Management Database. It sounds technical, but just think of it as the single source of truth for every single digital and physical asset the company owns.
So every server, every laptop.
Every server, every laptop, every software license, every router, every mobile phone, and crucially, not just a list of those things, but how they all relate to each other. This server runs this application, which is used by this department, and depends on this database.
It's not just a list of stuff. It's a living map of the company's digital nervous system.
Precisely. And then it gets even stickier. On top of that data map, companies write thousands, sometimes tens of thousands, of custom scripts and workflows. They use ServiceNow's proprietary scripting language to build bespoke business logic.
Like, if a server goes down in the Ohio data center, automatically check the backup server in Texas, page this specific VP, and open a priority 1 ticket with this specific vendor.
That exact logic, hard-coded directly into the ServiceNow platform. So to rip ServiceNow out, you don't just cancel a subscription. It's not like unsubscribing from Netflix.
You have to untangle a decade of what people call spaghetti code.
Exactly. And business logic that probably nobody who currently works there even fully understands anymore. The person who wrote it left 7 years ago.
That's the legacy debt moat, which sounds like a negative thing, but for an investor, it's beautiful. It means the customer is effectively trapped.
Trapped is a harsh word, but from a financial perspective, it's accurate. It creates what we call process power. The pain of switching is so astronomically high. We're talking a multi-year implementation, tens of millions of dollars in consulting fees, and the very real risk that your business literally stops functioning during the transition.
The benefit of switching to a cheaper competitor would have to be just massive to even consider that risk.
Massive, and this shows up directly in the numbers. Look at their retention rate.
It's elite.
It's 98%. That's the renewal rate. 98 out of every 100 customers renew their contract every single year.
And for context, in the world of software for small businesses, getting 85% is considered good.
In enterprise, 98% is the absolute gold standard. It tells you that despite all the noise, despite the headlines about AI and new competitors, when push comes to shove and the renewal is on the desk, the CIO signs the check.
However, and you knew there was a however coming, this is where the red team comes in. This is the heart of the bear case. The bear case isn't that customers are going to leave tomorrow. I don't think anyone believes that. The bear case is that this 98% retention figure is a lagging indicator.
A look in the rearview mirror.
Exactly. It tells you what happened last year. It doesn't tell you what happens when the SaaSpocalypse truly hits and those contracts come up for renewal in 2027 or 2028.
And that is the nuance we have to wrestle with here. The bears argue that, yes, retention is high because the contracts are long and the pain of switching is high, but that the utility of the platform is slowly, silently eroding.
So if I'm a red team analyst, I'm looking at the unit economics and I'm saying, okay, you have the customer locked in now, great. But if AI agents start automating the very work that your platform manages, does that customer really need to buy more seats from you next year?
Or do they need to buy fewer? This is the deflationary argument, and this is probably the core of the whole existential threat we need to discuss in segment 2.
Let's really drill into this because it's critical. We talked about switching costs being the moat, but there's a concept in strategy called counterpositioning.
Right, from the book Seven Powers.
And it describes a situation where a new technology comes along that the incumbent ServiceNow, in this case, cannot easily adopt without destroying their own business model.
And the specific threat here, the counterpositioning threat, is the no-code revolution being driven by generative AI.
Okay, explain the difference. ServiceNow has spent years building what they call a low-code platform.
Right. Low-code was revolutionary 10 years ago. It meant you could drag and drop boxes on a screen to create a workflow. You didn't need a hardcore C++ engineer to build a simple business app. A business analyst could do it.
But generative AI is no code.
It's no code. You don't drag boxes, you just speak. You type a sentence into a prompt. You say, build me an application that tracks employee vacation time, sends an alert to their manager for approval, and then syncs the approved days with the central payroll system.
And the AI just writes the code, builds the database, and launches the interface in seconds.
We are seeing early versions of this right now with tools from Replit, even some of the stuff inside GPT-5. And if that becomes reality, if that becomes easy and reliable, then ServiceNow's process power suddenly looks like a liability.
The fact that it's this rigorous, structured, heavy platform becomes a disadvantage.
It's a bug, not a feature. I don't want a heavy platform anymore. I want a fluid, instant, disposable solution.
The bears argue that ServiceNow is the Blockbuster of process. Blockbuster had a great physical distribution network, the stores.
The best in the world.
But Netflix had a better one, the internet. ServiceNow has a great process distribution network, the platform. But if AI allows every single employee to generate their own mini-apps on the fly, that centralized platform starts to look like a bureaucracy.
It looks like a toll booth that everyone is actively trying to drive around. This is the CIO's old nightmare of shadow IT, but on steroids.
Explain that. Shadow IT used to be a bad word. It meant people using their personal Dropbox instead of the approved company server.
It was seen as a security risk, a compliance problem. But now, in the age of AI, shadow IT might just be called efficiency.
So if the marketing department can build their own perfect campaign tracker using an AI agent for $20 a month, why on earth would they go to the internal IT department and pay $50,000 for them to spend 6 months building a clunky version of it in ServiceNow?
They won't. That is the hollow platform risk. And it's a subtle risk. It's not that companies rip out ServiceNow immediately. The risk is that they just stop adding to it.
All the new workflows, all the innovative stuff starts happening outside the platform, out on the agile AI edge.
And ServiceNow slowly, quietly becomes a legacy database. It becomes the place where you keep the old records, but not where the actual work gets done anymore.
There's also this Kodak aspect of the problem. It's a classic innovator's dilemma.
Oh, absolutely.
Kodak famously invented the digital camera, but they couldn't bring themselves to sell it because they knew it would kill their high-margin film business.
Cannibalize the golden goose.
Right. And ServiceNow is pushing its own AI product, Now Assist. But let's think about this. If Now Assist is actually really, really good, and it answers a user's question instantly without ever needing to open a ticket, doesn't that directly kill the core metric of the platform?
It cannibalizes the very seat you're trying to sell. If the AI solves the problem, I don't need a human help desk agent to log in and look at the ticket. If I don't need the human agent, I don't need to buy a license for them.
So ServiceNow is in this very, very difficult strategic position. They have to embrace AI to stay relevant. But if they embrace it too well, they might just accelerate the destruction of the total addressable market for their core seat-based pricing.
It's a strategic tightrope walk. So how do they counter that? They're trying to pivot their pricing model.
To what?
To a consumption-based model. They want to start charging per outcome or per agent action or per workflow executed. But that is a messy, painful transition.
Wall Street hates transition.
Hates them with a passion. It makes revenue unpredictable. We saw this whole movie before when Adobe moved from selling boxes of Photoshop to the Creative Cloud subscription. Their stock got absolutely hammered for 2 years before the market understood the new model and it took off. ServiceNow might be facing a similar valley of death period as they try to figure out how to monetize AI without killing their cash cow.
And while they're stuck in that valley trying to figure it out, we're seeing the leading indicators start to flash yellow. The 98% retention is solid. That's the lagging indicator. But the new logo, ACV,
Annual contract value from brand new customers.
that's starting to slow down.
That's the smoke before the fire. That's the canary in the coal mine. CIOs are pausing. I've spoken to folks in the industry, and the sentiment is one of hesitation.
What are they saying?
They're saying, look, I have a $5 million renewal coming up with ServiceNow. Do I sign a new 3-year deal and lock myself in? Or do I just sign for 1 year and wait and see what these AI agents from Microsoft, from Salesforce, from Google can actually do?
And that hesitation, it just crushes growth rates.
It crushes them. And when you are priced as a growth stock, any hesitation, any slowdown leads directly to the kind of multiple compression we are seeing right now.
So the market is pricing in fear. It's pricing in a future where ServiceNow is fundamentally less relevant. But as contrarian investors, we have to look past the narrative. We have to look at what the company is actually doing with its cash.
Actions speak louder than scary stories.
Exactly. Which brings us to segment 3. Financial resilience and what some call the institutional imperative.
This is where we have to separate the horror story from the boring spreadsheet. And the spreadsheet is telling you something very, very interesting.
Which is what?
Management has just authorized a $5 billion share repurchase program.
$5 billion. In a market where every analyst is screaming that the sky is falling on SaaS, the people who know the business best are writing a check for $5 billion to buy their own stock.
We have to apply the outsiders test here. There's a brilliant book by William Thorndike called The Outsiders, and it analyzes CEOs who were masters of capital allocation.
I know it well.
The core lesson is simple. When your stock is expensive, you use it as currency to buy other companies. When your stock is cheap, you buy it back aggressively.
And ServiceNow used to trade at 60 times earnings. Buying back stock back then would have been just lighting money on fire.
A terrible use of capital. But now, at around 25 times forward earnings, the math changes completely. This looks like an opportunistic buyback, not just a defensive one.
What's the difference?
A defensive buyback is when management is just trying to prop up the stock price, even if the business is deteriorating. An opportunistic buyback is when the CEO looks at their calculation of intrinsic value, sees it's, say, $150, then looks at the market price of $102 and says, wait a minute, I'm buying our own dollars for 65 cents. I'm going to do that all day long.
So it signals immense confidence. It's management saying, we see our sales pipeline, we see our renewal conversations, we know our business better than you do, Wall Street, and we think you are fundamentally wrong.
That's the signal. But there is a devil's advocate argument here, and it's a big one. We have to talk about the funding of this buyback and the dirty secret of Silicon Valley.
Stock-based compensation, SBC.
The elephant in the room for almost every tech company and ServiceNow is historically a heavy offender. If you look at their cash flow statements, roughly 20 to 25% of their operating cash flow wasn't cash at all.
It was stock issued to employees.
Exactly. Can you just explain that mechanism for listeners who might just look at the headline operating cash flow number and think it's all hard dollars?
Sure. So when ServiceNow pays a top AI engineer, say a salary package of $300,000, they might pay $150,000 in cash and the other $150,000 in the form of stock options or, more likely, restricted stock units, RSUs.
Right.
On the GAAP income statement, that's an expense. But on the cash flow statement, that stock portion gets added back as a non-cash expense, which makes their operating cash flow look huge. But for you, the shareholder, it is a very real cost.
It's dilution.
It's pure dilution. It increases the total number of shares outstanding. It's like having a pizza and the company just keeps slicing it into more and more pieces. Your slice gets smaller.
And this is where it gets tricky. With the stock price down 25%, that dynamic gets even worse, doesn't it?
It gets much worse. Because if the company promised you $150,000 worth of stock and the stock price drops in half, what do they have to do? They have to give you twice as many shares to make you whole.
It's the dilution spiral. It's a vicious cycle. If the stock keeps dropping, they have to print more and more shares just to retain their top talent, especially those critical AI engineers who are getting multi-million-dollar offers from OpenAI and Google.
So when we see a $5 billion buyback, we have to be cynical. We have to ask the hard question. Is this buyback actually reducing the share count? Or is it just soaking up all the new shares they're printing to pay their employees?
It's like running on a treadmill. You have to run incredibly fast just to stay in the same place.
So what's the verdict for ServiceNow? Is it a real buyback?
In this case, at $5 billion, it's a large enough authorization that it should result in a net reduction of the share count. But investors need to watch the weighted average shares outstanding line item on the quarterly report like a hawk.
That's the tell.
That's the tell. If they spend $5 billion and the share count stays flat or even goes up slightly, that tells you the SBC burden is absolutely massive and the buyback is just for show.
Okay, so that's a major risk to watch. But despite the SBC, one thing that looks pretty good is that their margins are expanding. They're actually showing real operating leverage.
That is the saving grace here. The business model itself at this scale is incredibly efficient. Their sales and marketing expense as a percentage of revenue is consistently dropping.
Why is that?
Because they don't have to fight as hard to get the next dollar of revenue. The install base is so loyal, so sticky, that the sales process becomes much easier. It's all about cross-selling.
Land and expand model.
Precisely. The salesperson calls up a happy ITSM customer and says, oh, you like our IT product? Why not add our HR onboarding module? Why not add our customer service platform? That incremental sale is incredibly cheap and incredibly high margin. So even with this giant AI threat looming, the actual profitability of the core engine is improving.
Okay, so we have this really conflicted picture. A super strong, profitable core business with a huge moat, a terrifying existential threat from AI, and a management team betting $5 billion on themselves, but with a potential SBC problem underneath.
It's a messy one.
Let's try to put a price tag on all this. This is where the rubber meets the road. Segment 4, Valuation Triangulation.
My favorite part. Let's leave the stories and opinions at the door for a minute and just look at the math. I always like to start with a reverse DCF, a reverse discounted cash flow.
Okay, walk us through that. So instead of us trying to predict the future and come up with a price,
We do the opposite. We look at the price the market is giving us right now and work backwards to see what kind of future that price implies.
what is the market baking in?
Exactly. We take the current price, around $102, we look at their free cash flow per share, and we ask the simple question: what growth rate does this company need to achieve over the next 5 to 10 years to justify today's price?
And what's the answer?
When you run the math at this 25 times forward multiple, the market is pricing in roughly 10 to 12% annual growth for the next 5 years.
10 to 12%. That seems low.
It's very low because the consensus from every major analyst on Wall Street, the people who model this company for a living, is projecting 17 to 20% growth over that same period.
So that's the mismatch. That's the potential opportunity, the alpha.
That is the entire ballgame right there. If you believe the analysts, hell, even if you think they're too optimistic and you believe ServiceNow can only grow at 15%, then the stock is mathematically undervalued today.
The market is pricing it like a mature, slow-growth utility company.
Like a Cisco or an Oracle. But the actual fundamentals still look like a growth company.
So that suggests the downside is somewhat protected. The market has already priced in a collapse in gross. If that collapse doesn't happen, the stock has to re-rate higher.
That's the argument. If the SaaSpocalypse is just a ghost story and ServiceNow keeps chugging along at 18% growth, then this stock shouldn't be at $102. It just shouldn't.
Okay, so let's try another method. Let's look at intrinsic value using a mean reversion approach.
Right. So we talked about how the historical PE ratio was up in the stratosphere at 60 times.
We're never going back there. That was the bubble.
No, 60 times is gone. Good riddance. But let's assume a rational, sane premium for a high-quality, monopoly-like software business. Let's say 30 times earnings. That feels reasonable for a company with 98% retention and expanding margins.
Okay, 30 times.
If we just apply a 30 times multiple to that consensus 2020 earnings per share estimate of $4.12, we get a share price of roughly $123.60.
So that's about a 20% upside from where we are today, just based on a sane valuation multiple without any heroic growth assumptions.
Correct. And we can try a third method. Let's look at owner earnings. We take the free cash flow per share, which is around $3.50, and let's assume it grows at a conservative 15% for the next decade, which, again, is a lower hurdle than the 20% analysts expect.
And what does that give you?
When you discount that cash flow stream back to today, you land on a fair value of around $110.
Okay, so we're triangulating. We have a few different methods, all pointing to a fair value zone of, say, $110 to $125.
That seems to be where the math points.
But we are value investors at heart. We don't just want to buy a dollar for 95 cents. We want a margin of safety. We want to buy it for 70 cents.
That is the discipline.
Yeah.
And you have to respect the narrative. The narrative right now is a falling knife. Sentiment is absolutely in the toilet. And when sentiment is this bad, stocks often overshoot to the downside. They don't just gently float down to fair value, they crash right through it.
So where is our buy zone? Where does the risk-reward become so skewed in our favor that we have to step in?
Based on our analysis, the price where the opportunity becomes truly asymmetrical is between $85 and $95 a share.
85 to 95. So that implies another, 10 to 15% drop from current levels.
It does, and it could easily happen if they miss on one earnings report, if a major competitor like Microsoft announces some breakthrough AI agent. We could see $88 very, very quickly.
And at $88.
At $88, you are getting the chance to buy a 25% growth compounder for less than 22 times earnings. That is the kind of setup that creates multi-baggers over a 5 to 10-year period.
But to hold this stock through 2030, you need more than just a cheap entry price. You need a vision of what the company actually becomes. It can't just be, well, it was cheap when I bought it. We need to understand the end game.
Agreed. We need to think about the long-term story. Let's move to segment 5, the long horizon.
So what's the mental model here?
We need to shift our mental model entirely. For the last decade, ServiceNow was a hyper-growth story. It was all about top-line revenue growth at all costs. For the next decade, it's going to transition into an industrial-grade compounder.
And you have a name for this phase.
We call this the Cannibal phase.
The Cannibal. It sounds aggressive.
It is aggressive financial engineering, and it's beautiful when it works, as their revenue growth naturally slows down because of the law of large numbers. I mean, it's just really hard to grow 20% when you're already doing $15 billion in revenue. They will shift their capital allocation strategy.
They won't need to reinvest every single dollar back into sales and marketing just to grow?
Correct. The business will become a cash-generating machine, a fire hose of free cash flow.
And what do they do with all that cash? They eat themselves.
They cannibalize their own share count. Our model suggests that by 2028, if growth slows to that 10 to 12% range, they could be deploying 80 to 90% of their free cash flow directly into share buybacks. They could be retiring 3 to 4% of the entire company's float every single year.
The math on that is just incredible. People underestimate it.
Yeah.
Even if your top-line revenue only grows at 10%, if you're reducing the share count by 4%, your earnings per share grows at 14 or 15%.
You manufacture growth on the bottom line, even if the top line is becoming a little more boring.
It's the Apple playbook.
It's the classic Apple playbook. Apple hasn't had mind-blowing revenue growth every single year for the past decade, but the stock keeps going up because they buy back tens of billions of dollars of stock every quarter. ServiceNow is just entering that phase of its life.
You could even see a dividend at some point.
By 2030, I wouldn't be surprised at all to see them initiate a small dividend to anchor the stock price and attract a whole new class of investor, like pension funds.
But for this cannibal thesis to work, the business has to survive the AI onslaught. We've modeled two very different paths for the next decade. The fork in the road.
A huge fork in the road.
Let's start with the bull case. The optimistic path, you call it. The control tower.
The control tower thesis is the direct counterargument to the AI chaos theory. It assumes that large regulated enterprises cannot just let thousands of autonomous AI agents run wild across their organization.
It would be anarchy.
It would be a compliance disaster, a security nightmare. Imagine you have an AI agent in HR that's hiring people, and another AI agent in finance that's paying people, and a third in IT giving them system access, and they aren't perfectly synchronized. You have fraud risk, you have data leaks, you have regulatory fines.
So the enterprise C-suite slams on the brakes and says, stop. We need a governance layer. We need a central nervous system.
Exactly. And ServiceNow positions itself to become that compliance and orchestration layer. They go to their customers and say, look, you can use any AI agent you want. Use Google's, use Microsoft's, use Anthropic's. We don't care. But it has to connect through the ServiceNow platform so we can log it, audit it, control its permissions, and ensure it follows company policy.
In that world, ServiceNow becomes the Windows of the enterprise.
That's the perfect analogy.
Yeah.
It's uncool, it's boring, nobody loves it, but it is absolutely ubiquitous. And they get to extract a small tax on every single automated workflow that runs through the enterprise.
And in that scenario, they successfully transitioned from seat-based pricing to consumption pricing. They charge a microtransaction per agent task.
And if they pull that off, our model puts the 2030 share price at around $137.50. That represents a very, very significant compound annual return from today's prices.
Okay, that's the dream. Now give us the nightmare. Path B, the hollow platform.
This is the bear case. This is the scenario where the no-code revolution wins. The technology moves so fast that any centralized governance layer is seen as a bottleneck, as bureaucracy.
Individual departments realize they can build better, faster, cheaper apps directly on top of a large language model without ever needing to touch the slow, expensive ServiceNow platform.
And the platform becomes a relic. It's like a fax machine in the year 2005. You still have one in the corner, but nobody ever uses it for anything important.
The new work happens elsewhere.
Seat counts collapse by 30, maybe 40%. The 98% renewal rate finally cracks and drops because customers wake up and realize they're paying millions of dollars for shelfware.
And in that world, ServiceNow becomes what?
It becomes a legacy zombie. Think of the mainframe computer companies of the 1990s. They still exist. They still milk cash flows from their old customers, but they don't grow. They're irrelevant.
And the stock's valuation in that scenario?
It completely compresses to a utility or a value trap multiple, maybe 15 or 18 times earnings. In that scenario, our model shows the stock trading at roughly $67.50 in 2030. That's a wealth destruction event from today's price.
So the spread between the two outcomes is massive, down to 67 or up to 137. It all hinges on whether they can successfully capture and tax the AI workflow or if they get bypassed by it entirely.
And that is why the entry price is everything. It is the single most important variable for an investor today. If you buy at 102, you need the bull case to work out to make good money. But if you get to buy at 85, you have a huge cushion.
A margin of safety.
A huge one. Because even if they land somewhere in the messy, muddy outcome where they don't die but don't thrive either, you'll probably still make 8 or 9% a year just because of the massive share buybacks.
This has been an absolutely incredible breakdown. Let's bring it all home with the outro and our final verdict. We like to give a letter grade on these two key factors. First, where do you stand on the quality of the business itself?
Quality score. I'm giving it an A-. You simply cannot ignore a 98% retention rate and that heart transplant dynamic. The switching costs are real, they are powerful, and they buy the company time. They give them a 3 to 5 year window to figure out this AI transition. It is fundamentally a high-quality asset.
Okay, and the valuation score as of today?
I'll give the valuation a B+. It's not a screaming, table-pounding, back-up-the-truck buy quite yet, in my opinion, but 25 times forward earnings for a monopoly-like software asset with these margins is objectively attractive. The market is pricing in a structural disaster that has not actually shown up in the financial statements yet.
It's pricing in the fear of the ghost, not the ghost itself.
That's a perfect way to put it.
So let's summarize the whole deep dive. The bull case is, the SaaSpocalypse is just a panic. Enterprises will always need governance, and ServiceNow will evolve to become the control tower for AI. The buybacks will create a floor under the stock and drive EPS growth for years.
And the summary for the bears is, deflation is real. AI reduces human headcount, which crushes the seat-based model. Stock-based comp dilution is dangerously high, and you are trying to catch a falling knife in the middle of a once-in-a-generation technological platform shift.
I want to leave our listeners with something very specific, a concrete action plan. We don't just want to leave them with theory. What is the one key metric they need to watch over the next 12 to 24 months to know which path, the control tower or the hollow platform, we are actually on?
Forget the headlines. Forget the flashy product announcements from their marketing department. Watch one number and one number only. The net retention rate, NRR.
Why NRR specifically, and not the gross retention we talked about earlier?
Because NRR measures the total health of the existing customer base. It doesn't just tell you who renewed. It tells you if those renewing customers are spending more money with you upselling or less money downselling. It's the definitive tell. The hollow platform thesis explicitly predicts that NRR will collapse as customers start reducing their seat counts.
What's the danger zone? What's the number that says get out?
96%. The day their net retention rate drops below 96%, the bear case is proving true. It means the deflationary force of AI is winning and customers are spending less. Sell the stock immediately, do not pass go, do not ask questions.
And the bull signal.
But if that NRR number stays above 97%, and at the same time you see the total share count drop by 15% or more over the next 3 years because of the buybacks,
Then what?
then the floor secure, the control tower thesis is working, and you are owning a compounding machine that will likely make you very wealthy over the next decade.
There you have it. Watch the NRR, watch the share count, and ignore the noise.
Simple as that.
Thank you all for tuning in to this deep dive on ServiceNow. It's a complex, messy story, but that's where the opportunity lives, in the complexity.
See you in the next deep dive.
Take care, everyone.